Cryptocurrency is a type of digital or virtual currency that uses cryptography for security. Unlike traditional currencies issued by governments, cryptocurrencies are decentralized and rely on blockchain technology to operate. Here's an overview of how cryptocurrencies work. 1. What is a cryptocurrency? A cryptocurrency is a form of money that exists purely in digital form. It operates independently of a central bank and is typically decentralized, meaning no government or financial institution controls it. Popular examples include Bitcoin, BTC, Ethereum, ETH, and Ripple XRP. Cryptocurrencies are built on blockchain technology, a secure and transparent digital ledger that records all transactions across a network of computers. 2. How does blockchain technology work? A blockchain is a distributed ledger that records all transactions in a secure, chronological, and transparent way. It consists of a chain of blocks, where each block contains a list of transactions. Decentralization. Blockchain operates on a peer-to-peer network, meaning there is no central authority. Instead, transactions are verified by multiple participants, called nodes, on the network. Immutability. Once a block is added to the blockchain, it is nearly impossible to alter. This ensures data integrity and transparency, as everyone on the network has access to the same information. Security. Cryptocurrencies rely on cryptographic algorithms to secure transactions, making it difficult for bad actors to alter or hack transaction data. 3. How do cryptocurrencies work? Cryptographic security. Each cryptocurrency user has a public key, like an address, and a private key, like a password. The public key is used to send and receive transactions, while the private key is used to sign off and prove ownership of the funds. Transactions. When someone sends cryptocurrency to another person, they create a transaction. This transaction is then broadcast to the network, where it is verified by miners or validators, depending on the cryptocurrency. Mining, proof of work. For cryptocurrencies like Bitcoin, mining is the process by which transactions are verified and added to the blockchain. Miners use powerful computers to solve complex cryptographic puzzles. When they solve the puzzle, they add the new block to the blockchain and are rewarded with new cryptocurrency tokens, like Bitcoin. Proof of stake. Other cryptocurrencies like Ethereum, after its transition to Ethereum 2.0, use a proof of stake, POS, consensus mechanism. In POS, validators are chosen to verify transactions based on the amount of cryptocurrency they stake or lock up as collateral. This reduces the need for energy-intensive mining. 4. Decentralized finance, DeFi. Many cryptocurrencies support DeFi applications, which allow users to engage in financial activities like lending, borrowing, and trading without intermediaries, such as banks. DeFi platforms use smart contracts, self-executing contracts with the terms directly written into code, to automate these processes, ensuring transparency and reducing costs. 5. Wallets and private keys. To store and access cryptocurrency, users need a digital wallet. A wallet is a software application or hardware device that allows users to store their private keys and manage their crypto assets. Hot wallets are connected to the internet, making them more convenient but also more vulnerable to hacking. Cold wallets are offline and provide more security, making them suitable for long-term storage. 6. Why is cryptocurrency valuable? Scarcity. Most cryptocurrencies like Bitcoin have a fixed supply. For instance, Bitcoin's total supply is capped at 21 million coins. This scarcity often drives demand, increasing the value of the cryptocurrency over time. Utility. Some cryptocurrencies like Ethereum offer more than just a store of value. Ethereum enables decentralized applications, dApps, and smart contracts which have real-world use cases across various industries. Security and trust. Cryptocurrencies are based on blockchain technology, which is known for its security and transparency. This can build trust among users, increasing demand. Decentralization. The absence of a central authority means that cryptocurrencies are immune to government interference, inflation, or censorship, which makes them attractive to certain users. 7. Buying and selling cryptocurrency. Cryptocurrencies can be bought and sold on cryptocurrency exchanges like Coinbase, Binance, or Kraken. Users can exchange fiat currency like USD for crypto, or trade one cryptocurrency for another. Price volatility. Cryptocurrencies are known for their price volatility. While the value can increase rapidly, it can also drop sharply. This makes cryptocurrencies an attractive but risky investment for traders and investors. 8. Use cases for cryptocurrency. Payments. Some cryptocurrencies, like Bitcoin and Litecoin, are used as digital currencies for peer-to-peer payments or to pay for goods and services. Store of value. Many people treat Bitcoin and other cryptocurrencies as a store of value, similar to gold, due to their limited supply and ability to protect against inflation. Smart contracts and dApps. Cryptocurrencies like Ethereum enable the development of decentralized applications, dApps, and smart contracts. These can be used for anything from decentralized finance, DeFi platforms to gaming and supply chain management. Tokenization of assets. Cryptocurrencies can represent real-world assets like property, art, or stocks through tokenization, allowing for fractional ownership and easier transfer of assets. NFTs, non-fungible tokens. Cryptocurrencies are used to buy and sell NFTs, which are digital assets that represent ownership or proof of authenticity of a unique item, such as art, music, or collectibles. 9. Risks and challenges. Volatility. Cryptocurrencies are highly volatile, and their value can change drastically in short periods, making them risky investments. Security. While blockchain is secure, exchanges, wallets, and other platforms are not immune to hacking. If a user loses access to their private keys, they lose access to their cryptocurrency. Regulation. Governments and financial regulators around the world are still figuring out how to regulate cryptocurrencies. Regulatory changes can impact the value and usability of cryptocurrencies. Scams and fraud. The crypto space has seen its fair share of scams, Ponzi schemes, and fraudulent projects. It's essential for users to be cautious and do proper research before investing. 10. The future of cryptocurrency. Cryptocurrencies have the potential to revolutionize finance by providing a decentralized, secure, and efficient way to transfer value. However, their widespread adoption depends on factors like regulatory clarity, technological advancements, and broader market acceptance. As blockchain technology matures and more people and businesses embrace crypto, the role of cryptocurrency in the global economy will likely continue to grow. Overall, cryptocurrency works by leveraging blockchain technology to enable secure, decentralized, and transparent transactions. While still a relatively new and rapidly evolving field, cryptocurrencies offer numerous use cases, from digital payments to decentralized finance, DeFi, and tokenized assets. However, they also come with challenges such as volatility, security risks, and regulatory uncertainty. Understanding how cryptocurrencies work is essential for anyone looking to participate in this space.